back to earnings, though. Earnings season officially kicks off this afternoon when Alcoa reports after the bell. Our next guest says we're in the 9th inning of the 2009 market rally. He's Rick Bensignor. He's a chief market strategist for Execution LLC. And thanks so much, Rick, for being with us. And, of course, a lot of anticipation for the earnings reports coming up. According to our Bloomberg analysis, we're expecting a pretty big quarter, give or take what we're going to see from financials.
Well, you've got most stocks are looking to beat numbers, certainly from a year ago. The question is going to be now, are fundamental analysts accurate in their assessments for this quarter? If not, the market's going to come off. If we come in better than expectations, you will see a quick run.
Well, and, Rick raises a great point. We were talking earlier about how you've seen this continued strength in the material stocks of late. Alcoa is going to kick it off tonight, but it, along with U.S. Steel and some of the other materials, have been so strong in recent months.
Well, and I want to ask you, there have actually been price increases in December in steel. There were 2 week-to-week price increases. So, might there actually be some pricing power come back in the market that actually helps some sectors, and maybe this isn't the 9th inning?
Here's the way we look at it. The market's moved up so much since the March low. At some point, it makes sense to take profits. Now, we're not telling clients to go short. We're not saying get out of equities. We're saying take off underperformers and also look to names that have vastly overperformed and are expensive in fundamental terms. Now, what you do with the cash becomes your choice depending upon how aggressive or not you are, that this is, in fact, the 9th inning. We think it is. So we're more apt to park it in cash. If not, you could take from stronger sectors or weaker sectors and rotate.
And those sectors that you're talking about that overperformed or that outperformed, that you would take money off of would be what? Healthcare, for instance?
Well, we actually like healthcare for the first half of 2009. If you look at, and we like technology, and we like technology as a long-term outperformer. Now, we think from
that's where the growth has been, right?
It's where the growth has been, along with materials, and it's likely to be where it continues over time. Now, it doesn't mean every single year technology is going to outperform. But we suspect if you look at the move from 2000 to 2003, which technology got crushed, this thing built a base for years. In relative performance terms to the S&P, we think a long-term bottom's in place. So we'd like technology. What we don't like is, and it's kind of an eclectic mix, we don't like consumer discretionary, which has done rather well, but we think it's time to start taking off from there. We also don't like consumer staples. And the fact that both consumers are on the negative side of the equation is, as I say, kind of an interesting mix, along with utilities as 3 underperformers for the first half of 2000.
We've certainly heard other strategists talk about healthcare as a pick. Very quickly, 5 days of gains for the market. Now, the S&P is only up about 2.5% over that stretch, but you're a trend watcher. What does that tell you?
Well, it means that we start off the year with a bang. Lots of money comes in. I know people who actually put their entire 401k into the market first week of the year. I don't do that. I tend to spread it out and somewhat try to pick places. If you buy the market sell-offs, you get more per share. But there's big inflows into the market to start. The question is, will this actually follow through or not? We think we're at the point where the market could lift off very quickly and get perhaps a 5% move in the next few weeks. But that is the blow-off move. And you want to use this strength to lighten up.
Okay, Rick, great to have you with us. Thanks so much.